You take a look at Wells Fargo shares down currently about 5% in reaction to that net interest income and that net interest margin-ness. And I know you said on this morning's earnings call that NIM will likely compress further when it comes to the second quarter, but take us past then. How do you see this measure developing over the quarters to come and the year to come?
Yeah, well, thanks again for having me. And just one correction there. We talked about the net interest margin coming down a little bit in the second quarter. NII should be up, actually, versus the first quarter. So, but that aside, I think, I think you have to sort of look at the broader backdrop of what we saw in the quarter. And I think you can see a lot of this in our earnings materials. There's a lot of the metrics that sort of drive the P&L in this quarter, but also sort of, for the years to come, we're actually, showing really good momentum. You saw good growth in our auto originations, up 2x from what it was a year ago, 60% increase in card originations, 15% increase in new checking accounts. You saw our markets revenue up 19%, our banking revenue up 11%, good recruiting in our wealth management business, and good growth, starting to come through, from all the investments we've been making in the commercial banking business. So there was actually a lot of positives there. From a net interest income point of view, as you look at the year, it's all the things that we actually expected to happen so far. And we're right where we thought we would be, given what we were seeing. You saw another good quarter of loan growth. You saw growth in interest-bearing deposits, and you have the impact of rates that that declined at the end of last year, sort of impacting the quarter overall. And then you saw our markets business growing, which is going to be very accretive over a long period of time. That has a small impact on net interest margin in the quarter.
Well, let's talk about that a little bit because, you think about some of the reasons why that you named growing the balance sheet in part to really grow the markets business was one of the reasons cited for why we saw this miss. And when it comes to the balance sheet, I know that we saw that asset cap lifted last year. That was certainly a big catalyst for shares. But where do you expect growth to come from here when it comes to the balance sheet? Is it more in the trading business? Are we talking commercial lending, consumer balances? Where do you see the most opportunity?
It's really across the board, and which is kind of the exciting part about where we have opportunity. In the consumer businesses, you're going to see the card balances continue to grow. You're going to see auto balances grow. You're going to see good stability in our mortgage portfolio, and we expect overall consumer deposits to continue to grow as we see more engagement with prospects and customers take hold there. On the commercial side of the businesses, we are going to see our markets, business grow, the balance sheet grow there, but it's not necessarily going to always be, some of the repo activity and some of these low ROA. We are starting to see, the pipeline get implemented for some of the other activity that we can do with these customers. We're seeing good traction in places like investment banking. We're seeing good new account acquisition sort of in the commercial bank with loan growth and deposit growth there as well. And then same thing in the wealth management business. So I think, as you look at the areas of growth, the good news is that we have opportunity to expect to see growth in every one of the businesses. Different ones of them will grow at different paces, but nonetheless, you'll see that over a long period of time.
Let's shift a little bit to private credit. You have around $36 billion tied to private credit. What's a stress scenario investors should think about? What's in your underwriting and your lending terms that protects you in case we see a downturn in the credit cycle?
Yeah, no, it's a great question and somewhat topical, and we tried to cover a lot of that today. And what you see in that portfolio are very conservative advance rates. So roughly about effective advance rates of roughly about 60%. So you can have cumulative losses of approximately 40% in sort of that portfolio. So it's hard to model a scenario where that'll actually come to fore. We also have diversification limits. We have structural enhancements where we underwrite each of the underlying loans that go into that portfolio. So we spent a lot of time making sure the structures are set up for it, that we understand the collateral that's in there, and over a very long period of time, this portfolio has actually performed very well from a credit perspective, and we think that's going to continue, and we're very comfortable with what we've got there.
And if inflation stays sticky and cuts get delayed, Will that affect your return targets? I mean, what specifically needs to improve so that you're on track for how you stay in the next couple of quarters?
I think we are on track to continue to improve the returns. And if you look at, we covered this on our call as well. If you look at like where we're going to get the enhancement in return, it's really a little bit from each of the businesses, and it's benefit from the investments that we've made now for 3, 4, 5 years in some cases. In our card business, as an example, we started, re-platforming all of our products 5 or 6 years ago at this point. And those earliest vintages are starting to really mature, and you'll see the profitability of that business, come through, over the coming quarters and next couple of years. You'll see, the investments in the corporate investment bank, the commercial bank, and WIM, and then broadly in consumer, come to bear. And so the good news is we're not over reliant on any one thing. And we're very confident in our path to get to 17 to 18%. And as we said in the past, we don't think that's the end. Once we get there, we'll kind of reset expectations for where the returns go from there.
Well, Isabel mentioned, stickier inflation, what that means for the Fed. I do want to talk just directly about higher oil prices, because you think about the consumer here spending more on gas as energy costs go up. I wonder what you're seeing in terms of spending patterns over the past month or so. And, if we see oil stay around these levels, when might that start to impact some of the other businesses, when you think about commercial lending to fertilizer companies, for example?
Yeah, well, look, on the consumer side, spending's been very resilient, through the last month. It's still up year on year every week. People are certainly spending more on gas than they were, before the conflict started earlier in March. But if you look in aggregate, it's about 3% of spend. If you look at for lower wage earners, it's probably closer to 6% of spend or 7% of spend. So it's not insignificant, but it's something that people can sort of manage around. And overall, you're still seeing very good growth. And you couple that with, really good credit performance still. And so it's not having an impact on, overall credit performance on the consumer side of the house. Delinquencies actual delinquencies are a little bit better than we model, not worse still. So quite constructive overall. Now, if it persists for a very long period of time, it will have some impact, but it's really hard to predict yet, what that will bring. And I think as long as unemployment stays low, people should be able to manage through this for some period of time. But it may have some impact the longer if oil stays higher for much longer.